Pass-through entities have been an enigma to accounting and valuation professionals for many years. Valuation itself can be a daunting undertaking, akin to a paint-by-number picture without the numbers. With a number of different models and approaches, there is no one right answer. But what exactly is a pass-through entity? A pass-through entity is a special business structure that is used to reduce the effects of double taxation. Pass-through entities do not pay income taxes at the corporate level. The income of such entities are treated as the income of the owners or investors. Technically, for tax purposes, flow-through entities are considered non-entities because they are not taxed. U.S. law requires flow-through entities to file an annual K-1 statement. Like many endeavors, the original purpose for which pass-through entities were created has long since been forgotten. But understanding the genesis of pass-through entities provides a rich fabric from which the accountant can create a more understandable and accurate pass-through entity valuation. In this segment, our own Rebecca Saran looks into pass-through entities and how the accountant should tax affect the earnings of a partnership, C corporation, limited liability company, or sole proprietorship when valuing such business ownership interests. She met with Eric Barr, partner in charge of valuation services at Marks Paneth LLP and author of the book Valuing Pass-Through Entities. Mr. Barr helps shed light on what he calls the PTE Conundrum, a topic that has been the subject of articles and books and has been contested in numerous litigations and in different courts with varying facts and circumstances.
Eric, I want to welcome you to the program this month.
Thank you, Becky. It's a pleasure to be here.
I know that you provide consulting services on all aspects of valuation. Can you start by telling us why is the topic of valuation important to CPAs?
Well, for CPAs to fully service their clients, they have to be aware that the business ownership interest is one of the most valuable assets a business owner has. And it's important for the CPA advisor to understand those factors that drive value, that create and enhance value. And so having an understanding of the factors that either increase or decrease value is critically important for a CPA advisor.
Okay, that certainly makes a lot of sense. So how is value defined for business appraisal purposes?
It's generally defined as the risk-adjusted present value of future economic benefits. Now, those economic benefits may be defined in a variety of ways. The most frequently applied definition would be after-tax cash flows. But depending on the industry and the circumstances, it might be EBITDA, EBIT, gross margin, or some other factor.
So under what circumstances would a client or CPA need to know the value of their business ownership interest?
There are a variety of reasons. If someone is thinking about a transaction involving their ownership interest, it could be for estate or gift tax purposes. It might be for litigation. It might be for merger or acquisition. It might be for an employee ownership, either through an ESOP or for a direct transfer. It could be for options or warrant valuation. It might be needed because the business owner is getting a divorce. And as part of the process of determining the amount subject to equitable distribution, they may need a valuation. So there's a host of reasons.
I guess there are a lot of reasons why a valuation might be necessary. Is value determined the same way in each circumstance?
No, it's not. You have, generally speaking, two different types of ownership interests. An ownership interest where the owner has the prerogatives of control, and other interests, often referred to as minority or non-controlling interests. Those two are vastly different. As a controlling interest holder, you could make decisions regarding whether a company wants to pay bonuses, not pay bonuses, dividends, expand, contract operations, hiring, a whole host of different factors. With a non-ownership interest, you're there and you're along for the ride. Maybe you have some influence, but you don't have control. So they're vastly different.
So we have controlling and non-controlling interests. With respect to valuation, what are some of the different valuation approaches that are commonly considered by business appraisers?
Well, there are different standard-setting bodies, and they all focus on three primary approaches, very, very similar to real estate appraisal. There's what's called the net asset approach. And in the net asset approach, you look at the fair market value of the assets and the liabilities, and the difference is the value. That's relevant for certain types of companies like real estate holding companies or investment companies, companies that don't have a lot of goodwill. Then there's the income approach. And under the income approach, you look at either the historical or future earnings of the company, and you risk adjust a present value of the future cash flows. That's the one method that's the one approach that's most commonly used, particularly for small owner-managed businesses, small and mid-sized owner-managed business. The third approach is called the market approach. And in the market approach, you look to see what other types of ownership interests have sold for. You might look at publicly held companies to see what the stock price is and what the valuation metrics are for a guideline public company. Or you might look at a private company transaction. The private company transactions involve controlling interests. Public company transactions typically are minority interests, but they're freely tradable. So you have differences between the guideline public and the guideline transaction method, but they're both market approaches that are referred to and relied upon by business valuation consultants.
Eric, you seem to keep coming back to the issue of control. How is value impacted by control?
Well, with control, one typically has a greater value than a pro rata share of the entire entity. With control, you could say that. If a business has a value of, say, $1 million, and one has control, 90%, you might attribute 90% of that $1 million to that ownership interest. But if somebody has the 10% ownership interest in that $1 million business, good luck finding somebody to pay $100,000 for it, because there's generally a discount from the pro rata share to come up with the value of that minority interest. And those discounts are often referred to discounts for lack of control, and sometimes those interests are not quite that marketable, that somebody might have to hold on to that interest for an extended period of time. And in those situations, there's a discount for lack of marketability. You typically don't have those types of discounts when valuing a control interest.
Eric, so now we've discussed the basics related to business valuation. Let's talk about pass-through entities. What exactly is a pass-through entity?
Oh, it's funny. I had this conversation with my parents the other day. My father's 88, my mom's 85, and they were very excited that I was writing a book. And I presented to them, and I showed them the different sections in the acknowledgement. They're very pleased, and they were all excited. And then they closed the book, and they saw the title, Valuing Pass-Through Entities, and they said, "What's a pass-through entity?" So the way I explained it to them was, number one, it has nothing to do with your bowels. It's not a pass-through in that sense. What it is it's the type of company where there's no income tax paid at the entity level. Rather, the revenues, expenses, and all of the other tax attributes pass through to the owners. That contrasts with a C corporation. Public companies are typically C corporations, where there is a tax at the entity level. And there's a second tax when dividends are paid out of the company and received by the shareholders. So with a pass-through entity, there's one level of taxation at the owner level. With a C corporation, you have two.
Okay, I understand what you're saying about the differences between taxation of a C corporation and that of a pass-through entity. So how prevalent are pass-through entities?
Well, it's quite prevalent. Annually, the IRS releases data on all sorts of different data, including the number of federal forms 1065, 1120-S, and 1120 forms that are filed. 1065 is partnerships and LLCs, 1120-S is S corporations, and 1120s are C corporations. And the statistics show a very clear and consistent trend. and that is there are more and more pass-through entities in the form of LLCs, partnerships, and S corporations than C corporations being filed each year. And the number of pass-through entities keeps growing. For the year ended 2012, 78% of all entities that file U.S. federal income tax returns are pass-through entities.
Wow, that's an amazing statistic. I didn't realize how prevalent pass-through entities are. What are some of the economic consequences of owning an interest in a pass-through entity versus owning the equivalent interest in a C corporation?
Well, if, let's say, as an investor, I could buy an ownership interest in a pass-through entity and in a C corporation. And just hypothetically speaking, they both generate $500,000 of pre-tax income at the entity level. Which entity would provide me with greater after-tax returns? With the pass-through entity, there's no tax at the entity level, assuming that that $500,000 is available to me to pull out of the company and that I don't need money to be retained in the business. I'm better off on an after-tax basis as an owner of the pass-through rather than the C Corp. Because with the pass-through, all of that income is taxed to me, so that if, let's say, at $500,000, I'm in a 40% tax bracket, that means there's $200,000 of tax. I keep $300 after tax. With the C corporation, there's a tax at the entity level. Again, assume that there's a 40% tax rate. It's $300,000. If the $300,000 is dividended out to me, well, I've got a dividend tax that I have to pay on that, which is roughly 20% plus the Medicare tax. But using just the 20% of 300 is 60, I wind up with 240. 240 versus 300. Very clear difference between the two.
Eric, I think I'm beginning to understand the difference between a pass-through entity and a C corporation. Are there valuation issues that are specifically related to pass-through entities? If so, what are they?
Well, that's the big issue facing the valuation profession. With so many companies, 78% of all companies being pass-through entities, it's one of the most important and critical issues that we as business appraisers have to deal with. And here's what the issue is. The valuation multiples are derived from public company valuation multiples. So if the public companies are C corporations and there are valuation multiples or capitalization rates derived from those public multiples, there's an assumption that there's two levels of income tax. But with pass-throughs, there isn't. It's only one level. So how do you reconcile that? How do you address the fact that your multiples are based on two levels of tax, but the entity that you're valuing only has one? Clearly, there has to be some adjustment made. That's what I call the pass-through entity, or PTE conundrum.
Well, that does sound like a conundrum. So how do you usually deal with that?
Well, in my book, Valuing Pass-Through Entities, I've researched a number of different cases, including Gross v. Commissioner, Estate of Adams versus Commissioner, and many others. And I've seen that those cases which relate to valuation dates prior to the 2003 change in tax law under President Bush all said that there should be no tax-affecting adjustment. Subsequently, there was a 2007 case involving a 2004 valuation, which said that there should be a valuation adjustment and an income tax adjustment for pass-through entities. And that was Delaware MRI v. Kessler. And they presented a model, which when you apply that model both to the 2004 case and to the pre-2003 cases, came up with results that were entirely consistent with the court decisions. I used a modified version of that Delaware MRI model because the Delaware MRI model although conceptually sound and entirely consistent with all of the other cases, was based on the facts and circumstances presented to the court in that instance. And so I've made some slight modifications to that to incorporate other potential facts and circumstances. That's what I use.
Thanks, Eric. We'll return to your commentary in a minute.
Abraham Lincoln caused the pass-through entity PTE Conundrum. Yes, that's right. We can blame Honest Abe, who on October 3rd, 1862, signed the Act of 1862, the first law authorizing U.S. income tax on individuals. The new law also provided for additional sales and excise taxes and introduced the inheritance tax. In 1872, after the Civil War, the income tax was eliminated, even though it proved to be a substantial revenue generator. Then in 1913, the 16th Amendment made the income tax a permanent source of revenue for the federal government. During the period from 1913 to the present, we have seen a wide range in the federal individual tax rates in the maximum income bracket. Immediately following its inception, federal individual statutory tax rates in the maximum income bracket soared during World War I, dipped during the Roaring '20s, and then rose to new heights during the Great Depression and World War II, peaking at 90%. Those rates would later plummet by approximately 20% in the 1960s, and then again under President Reagan in the 1980s to a low of 28%. Since 1990, federal statutory individual income tax rates in maximum income brackets have ranged between 30 and 40%. Very profitable businesses with taxable income in the maximum statutory income bracket and operating as PTEs would be subject to these tax rates at the individual owner level. Alternatively, businesses could operate as a C corporation and incur income taxes at the entity level. Throughout the history of the Internal Revenue Code, a pattern has emerged, and that is the following. Congress passes tax laws, taxpayers interpret these laws, the IRS then challenges taxpayer interpretations, taxpayers and the IRS then decipher court decisions, and then Congress again passes new laws. Let's return to Becky Saran and Eric Barr to learn more about the implications of income taxes on business value.
Okay, Eric, let's talk more about the implication of income taxes. What about them? How do income taxes impact business value?
The business owner is interested in what they could keep in their pocket at the end of the day, after tax. And so the after-tax returns to the owner is really what's critical. It's the primary value driver for most business owners. And so it's important to consider the fact that income taxes paid once with pass-through entities, paid twice with C corporations. It's a primary consideration, or it should be a primary consideration when valuing owner-managed companies.
Have changes in income tax laws and income tax rates impacted business value, and if so, how?
Well, Becky, I've been filing tax returns for a long time. I wouldn't say how long you've been filing them for, but what I can say is that when tax rates change, the after-tax returns change. And when you have major tax law changes, it impacts the after-tax returns to owners and the value of a business entity. Clearly, if you think about years ago, when for more than 40 years, the maximum tax rate for individuals exceeded 90%. People forget, but that's where the rate was. It exceeded 90% for more than 40 consecutive years. Now the maximum tax rate is less than 40%. The after-tax returns in those two scenarios obviously are vastly different. When you take a look at the tax rates before 2003 and after, you can see that it's very different. Before 2003, dividend income was taxed no differently than ordinary income. So it was subject to maximum individual income tax rates, north of 35%. With the George Bush tax cuts, the maximum rate was 15%. So you had this substantial 20+% decrease. That impacts after-tax returns, impacts valuation adjustments.
Eric, what guidance can our viewers gain from the tax court and other cases addressing business valuation?
It's really critical to understand the court's thinking in all of the relevant cases. That's much more important than what the ultimate decision was, because the facts and circumstances of a particular case may not apply to you, but the thinking and the foundational conceptual foundation that the court used to derive that conclusion will always apply. So I think that when you look at cases like Gross v. Commissioner, Delaware, MRI v. Kessler, it's important to understand the court's thinking. And the thinking that they had in each case, what I pulled from it, is that nobody's going to pay more for a business than what the owner can put in their pocket. That taxes do matter. Those are the two primary things.
Eric, let's talk more about the examples of pass-through entity business valuation case law that you mentioned. How do the court's findings differ, and how are they similar?
With Gross v. Commissioner, which is the granddaddy of cases, and that involved a valuation date in the mid-90s. This was before the Bush tax cuts. And in that instance, dividend income of C corporations were taxed no differently than ordinary income. So it was a very high rate. So the economics of owning a pass-through versus a C corporation were very different. The tax cost of owning a C corporation was immense, much greater than it was after the change in 2003. Because with the change in 2003, the tax on dividend income plummeted from high or mid-30s down to 15%. So the relative advantage of being a pass-through to a C corporation, instead of it being extremely sizable, was chopped almost in half, depending on the level of taxable income that you're dealing with. So that's a major difference. It's a factual inconsistency between the cases decided with valuation dates before 2003 and after the change.
Eric, earlier you talked about the Delaware MRI versus Kessler case. What is the modified Delaware MRI model, and how does it address the guiding principles contained in the cases that we just talked about?
Becky, we had talked about some other cases. In Delaware, MRI v. Kessler, which is a fair value case decided by the Delaware Chancery, in its reasoning, it cited Gross v. Commissioner and a host of other federal cases. And based on the fact that the income tax rates had changed and the tax on dividend income had changed, Delaware MRI came up with a methodology which effectively reverse engineered the income tax rate based on the facts presented. The modified Delaware MRI model, which is what I propose is the appropriate way to go about valuing pass-through entities in my book, takes that model and makes some very minor tweaks to take into consideration the possibility that there may be an entity-level tax, because we know that there's entity-level taxes on pass-through entities in New York City, for example, and other localities throughout the country. And also takes into consideration the possibility that income might be retained in the business, either for growth or working capital needs, or for debt service, or for other reasons.
Is the modified Delaware MRI model used solely for the income approach?
Yes, but the concepts contained in the modified Delaware MRI model also apply to the market approach, where under the market approach, valuation multiples from guideline public companies have two levels of taxation. If the subject company only has one level of taxation, again, there has to be some adjustment that's taken into consideration.
Is a fractional ownership interest in a pass-through entity equal to the value of the entire entity multiplied by the subject percentage interest?
Well, Becky, That really depends on facts and circumstances. Because if you're dealing with a control interest, then very possibly it does work out that way. If you're dealing with a non-controlling interest that has special rights, similar to what you might find with preferred stock, where there might be preferential distributions or participation rights or rights of conversion, you might have a situation where that minority interest has a value that's greater than a pro rata share. But you also have situations, if you're dealing with a minority interest, where it's worth less than a pro rata share because of discounts for lack of control or discounts for lack of marketability.
What suggestions do you have for accountants with regards to these issues? What should they be doing?
Well, if a CPA doesn't have the valuation talent in-house, they should seek to bring somebody in, a friendly business appraiser valuation consultant, who could, number one, protect the relationship with the client, but also complete the service offering to the client. You know, we're dealing in a time where many small to mid-sized businesses don't have access to capital. It's becoming increasingly difficult for many companies to sell their business as a result of a lack of capital out there. You have a baby boom generation that's aging, so there'll be many, many companies that'll be up for sale in the not too distant future. And with a business ownership interest, you're dealing in many instances with the largest single asset that the business owner has. So it's critical to understand what that ownership interest is worth, what actions enhance value, how to package that company in a way that down the road it is more marketable, has more value. So it's a critical issue for CPAs.
Eric, what are the documentation issues involved with this process, the valuation process?
It's important to understand the historical results of operations of a company before one could estimate what the future cash flows will be. Now, as accountants, we're trained to look at financial statements and tax returns, but in many owner-managed businesses, the reported numbers don't truly reflect the economic returns of the business. There are many instances where an owner might be pulling out far more than reasonable compensation or less than reasonable compensation, or there might be some non-recurring expenses that go through the business. We've recently gone through several winters where in one year we had an ice storm in October and another one we had a hurricane. And depending on the business, you might have significant non-recurring events. The business appraiser has to be able to look at the numbers, pull out the non-economic items, whether it's owner perquisites or other, pull out the non-recurring items, storm damage, and other non-recurring events to see what the recurring cash flows are to the owner. And only then, based on the true economic returns, can one come up with an accurate, reliable, understandable, and defendable valuation conclusion.
How about the IRS? Is there a likelihood that the IRS will challenge a CPA's valuation?
It's important to understand that with valuation in connection with a gifting of an ownership interest, an estate tax return, an employee transaction, or related party transaction, that there's a risk that the IRS will examine. And so it's important to prepare your valuation under the assumption that it will be challenged by the IRS and not cut corners. If you cut corners and then you have to defend it later on, it's a very awkward position. And that really brings up another point, which is the accountant that is the accountant of record for a company, the accountant that prepares the financial statements or the tax returns, is not the accountant that should be preparing the valuation. And here's why. First of all, it creates an independence issue. If somebody is preparing a valuation under the accounting rules, that impairs independence for the accountant that issues a reviewed financial statement or an audited financial statement. And it also impacts the credibility of the accountant if they have another income stream from that client, if it's later challenged and one has to testify in court. So accountants that are the accountant of record for a particular company should stay away from doing business valuations for that company.
Any other issues that our viewers should be aware of?
Yes, the area of business valuation is a highly controversial area. What might be of value to one person may not have the same value to somebody else. You know, I liken it to beauty in the eyes of the beholder. Well, value, like beauty, is in the eyes of the beholder. The value to the holder of an ownership interest might be vastly different than the value to the buyer, because the buyer may bring into play certain synergies with their operations, the ability to eliminate certain costs, the opportunity to expand a product line or a customer base, and derive much more value from that ownership interest than the seller. So the perspective of what is it that we're valuing and in the hands of which party becomes critical. Those are standard of value issues. And it's also important to realize that the IRS is all over estate and gift tax valuations. And be very careful about getting involved in preparing a business appraisal if you're unable to defend that appraisal in court.
Eric, we have covered a lot of ground today. If you could leave our viewers with one final thought, what would that be?
Valuation is a discipline that is fairly new. Unlike medicine or law, with 100+ years of history and guidance and guidelines and standards, our standards it's really only been around for 20 years as a formal profession. So it's something that's evolving. But with the evolution of the valuation standards, what used to be very disparate findings, over time, people are coming closer and closer. It's important, if you get involved with the valuation practice, to really understand the case law and the standards. Because otherwise, if you're involved in providing these services without that foundation, you're not doing yourself a service, and you're certainly not doing your client a service.
Eric, a lot of great information. Thanks for being with us today.
It's been my pleasure, Becky. Thank you.
My interview with Eric Barr concludes the July 2015 edition of the CPA Report. We look forward to bringing you up to date again with our August 2015 release.